I shared in the group. And I think everything is okay because I recorded and everybody can actually watch. Now we'll continue with the training, and with the training, we'll continue with this trading time and trading session. Actually, we started this yesterday, so continue with it. Now I explained everything about this trading time and trading session, but there's one thing I'll add here. Now, if you look at this time, the trading time, the different times, you see like the London session, it starts at 8, you see a bar from this 8 to 5. This other one, you see a bar from 1 to about 9. Now, you discover that between 1 and 9, between 1 and 5, you will see an overlap, what we call an overlap. So there's an overlap between the London session and the New York session during this time frame, between the period of within the period of 1 and 5. And what does that actually mean? It therefore means if you get on board between 1 and 5, that is when there will be high volatility in the market. And this explains why you can be on your chart and you are trading, you discover that between 1 and 5, you see very, very funny move and very, very fast move. So the trade can be consolidated, it can be just moving within a particular point, and at 1 o'clock, you see a very, very powerful move up or down. So you need to understand all these different time frames. Now, this is a question. On this chart, you discover this is a chart, and on this chart, you will see this is a London session, this is Asian session, this is New York session, and we have the different time frames within that session. Now, if you have a time frame, maybe if you have a London session that opens between 8 and 5, now you have a pair, a London pair, you have a GBP as a London pair, they have another pair, JPY, as an Asian pair. Now, do you trade it during the London session or do you trade it during an Asian session? Food for thought. Do you trade, let me repeat, do you trade it during, remember GBP is a London pair and JPY is an Asian pair. And I said, if you are trading, the pairs must appear in 2. And that is what we call a quote. Now, if you have a GBP/JPY, it means a London pair and an Asian pair. Will you trade this pair now during the London session or you trade it during an Asian session? Think about that. I'll give the answer now. So you think about that and try. First, it's about thinking out of the box. So just think about that and try to come out with the answer. It is a pertinent question. If you cannot answer that question, then things may be difficult. That is why I said introduction is very, very important. I mean, very, very important. Now, if we move to the next, let's move to the next, the forms of, or the types of forex traders. There are 4 different types of forex traders. 4. The first kind of trader, we have what we call a scalper, we have what we call a swing trader, we have intraday trader, and we have the last one, position traders. Those are the 4 kinds of forex traders. It is very, very important. Some people, they say they want to learn forex and they say they don't have time to trade. Because most of them, they think if you are a trader, you should be on your computer set for the whole day. That is not how it works. If you don't have time to trade, then choose the kind of trader that you are. And it depends on the attitude too. There are some people that are just impatient. If you are impatient, they cannot sit on your computer for up to 2 hours. Then you decide the kind of traders that you want. Now, let's start with scalping. Scalping, there are a particular kind of traders, and those kind of traders, they trade. When they are trading, they need to be on their computer for the whole day. So if they are trading for the whole day, they need to be on their computer set for the whole day. And their target is just to make between 10 and 15 pips. I'll explain what pip is. They make 10 and 15 pips and they go out of the market. So they open so many positions, but they make very few pips. Make few pips and they leave the market. They make few pips, they leave the market. So that is actually how scalpers are. Now, if you are impatient or you are too busy, I decide to be scalping, will you have the time to sit on your computer for the whole day? If you say you are trading for the whole day or you say you are trading for 2 hours, will you have the time? You will not have the time. So if you don't have the time, then forget about scalping. And scalping is very, very tedious because there is what we call trading emotion when it comes to forex. Trading emotion means you place a trade and you sit and watch. That's what we call babysitting the trade. If you are a scalper, and you are not very careful, trading emotion always comes because when you place a trade, most of them, they always sit and watch. And when you sit and watch, there's high probability of you closing that trade before you even get into profit. Then the next kind of trader is what we call the swing trader. And a swing trader places trade and keeps for days, 2 weeks. And the target is to make 100 pips and above. So if you're a swing trader, if you don't have time to trade, or if you don't have enough time, you can do an analysis during the weekend, and on Monday, the market opens. Remember I said the market is closed on Saturday and Sunday. So when the market opens on Monday, immediately you get a confirmation, you buy or you sell, and you leave the trade for the whole week. Just come back and check on Friday. So those are swing traders. Now, intraday traders are people that place their trade and they keep it for 1 day. They don't keep it for more than 1 day. Now, intraday traders can keep it for hours or they keep it for 1 day, but they don't keep their trade overnight. Then the last kind of trader is what we call the position trader, that they place their trade and they keep it for months. So you can place a trade and keep it for 1 year even. You place a trade in December and keep it for you till the next December. So those are the 4 different kinds of traders. Now you choose the kind of traders that you want to be. Choose the kind of trader that you want to be based on their characteristics. Don't get in because somebody is a day trader, you decide I want to do day trading. Don't get in because somebody is a scalper, you decide I want to scalp. If you do it that way, it will be difficult for you. The first is knowing yourself. So these are the 4 different kinds of forex traders. You must fall within one of them. But take note, there is no clear cut between all of them. There are times that I'm an intraday trader, but there are times that I actually scalp. There are times that I do swing. So it doesn't mean if you're a day trader, you should be stick only to day trading. If you see an opportunity to scalp, then you can scalp. There's no problem. See the opportunity, all the conditions met, you scalp. There's no big deal with that. So there is no clear cut that if you're a day trader, you must place a trade and keep it only for 1 day. If you see an opportunity to scalp, the market is open. You can switch from day trading, scalping, position trading, and the rest. But it is advisable to have a focus. So focus on a particular trading style. Now, terminologies used in forex. In forex, there are particular terminologies that you as a trader, you must understand. If you don't understand those terminologies, then it may be difficult first to understand the concept, and secondly, to actually trade. So we'll start with the first one. The first one is actually leverage. Leverage, simply in a layman's language, I teach for people to understand. In forex, the main thing is for you to know. It's not about knowledge. Books will give you complicated definitions, or they'll give you some funny things you will not understand. But that is not important to me. The most important thing is you knowing what it means and actually applying it on your chart. We are learning to make profit. We are not learning for knowledge sake. So a leverage in a layman's language is actually borrowed money, and it is expressed in a ratio. Now, you can have a leverage of maybe 1:200. You have 1:1, 1:200, 1:500, 1:1000, 1:3000. And if you have a leverage, you get a leverage when you are creating your account. So when you are creating the account, they ask you to select your leverage. You can choose maybe 1:200, 1:400, 1:1000, depending on you. Now, if you choose a leverage of 1:200, actually, what have you done? It means if you fund your account with $100, or let's say, for example, you fund an account with $10, then you choose a leverage of 1:200. It means actually you are working with $2,000. That is the meaning. Forget about book definition. That is the meaning, which means if you have a lower leverage, then you are working on a lower amount. When you have a higher leverage, you are working on a higher amount. But the issue is, if you choose that leverage and you fund an account with $10, it will not appear there. But you are the one that knows this is what I have done. It is very important. So if you choose a leverage of 1:200, it means that is it. But I'll advise the ideal leverage to use is 1:400 or 1:500. Now, this is a reason. If you choose a leverage of 1:200, there will be opportunities that you may not be able to place, because the second function of a leverage is it protects your capital, which means if you have a $10 account, you place a trade and it goes maybe 70% against you, the trade will close automatically. Take note, the trade will close automatically. Some people, they have been trading and some people, they contact me, they say those brokers are wicked. When I place trade, they close them. When you consume a certain percentage of your account, they will close it based on the leverage you choose. So if you choose a leverage of 1:400, it goes maybe 70, 80%, 60, 70, 80%. They start closing those trades for you because they want to protect part of your capital. But if you choose a leverage of 1:3,000, trust me, if you have a $10 in your account, they will only close that trade when the account goes down to 0.00. Which means if you use a higher leverage, you are at a higher risk. You can make good profit too, but you are at a higher risk of losing or blowing your account. This is what so many people don't know. Some people, they just choose any leverage because they want to choose. I will recommend a leverage of less than 500. If you want to use 400, fine. If you want to use 500, fine. If you want to use 200, fine. But me, I use leverage of 1:400 or 1:500. That is the IG that I use. If you want to go down to 200, you know you may have an opportunity and you'll not be able to trade because you have occupied all the space, you have occupied the recommended amount of your account. So it is very important to understand these things, please. Very, very important. So that is a leverage, and that is how you can trade it. I have taught people that have been trading for more than 2 years and they did not understand what leverage is, so they lost money based on this. Please understand these things. Where you use a wrong leverage, you know you may trade for 1 year and every day go back negative because of the leverage you choose. Do not be greedy. Do not be greedy. Do not think when you get to a leverage of maybe 1:3,000, you make more money. It's true, you can make more money. But the day that you lost a single trade, you may even lost the profit you have made and even the capital. So use the recommended leverage. Now, the next thing is actually a PIP. PIP is an abbreviation which stands for percentage in points. It stands for percentage in points. And in forex, we don't calculate money based on the number of the dollars you have made, but we calculate it based on pips. Take note, we calculate it based on pips. There's one funny guy, I don't know whether the guy is here. The guy has been disturbing me since yesterday, telling me nonsense, but when he sends a screenshot and he's just concentrating on the dollar, somebody will use a very high lot size and make 10 pips and the person start boasting. Now, this is how forex traders do. This is how they evaluate people. So many people, you may be here and you have contacted me. You have contacted me. At times I get very angry with people because the first is they don't even understand the dynamics. And when they send their screenshot, I see so mmany things. And I want you guys to see it that way. Somebody will send a result. The person you use maybe takes a high risk and the person makes $1,000. Another person takes a high risk and the person makes maybe another person takes a low risk and the person makes maybe $10. You discover that maybe the person that made $1,000 or the person that made $10 is by far more than that person that made $1,000. The problem now is the capital the person has and the risk the person took. So I would like you to concentrate on the number of pips that the person makes. So the pip is simply an abbreviation which stands for percentage in points. Now let's get to the chart so that I really explain and understand. It's like I forgot to, let me open the app, please. So when you calculate the pip is simply a calculation that you do, or you calculate the pip. Always convert that pip to the number of dollars you are supposed to make or you are supposed to lose. This is actually the technicalities in forex. Convert that into the number of dollars you are supposed to make or the number of dollars you are supposed to lose before you decide to place a trade. Now the chart has opened. Let me share the screen so that we continue. This is it. Demo account. Okay. So this is actually the chart, and I said this is a MetaTrader 4 account. Now on this MetaTrader 4 account, if you look on your right, try to annotate this thing. If you look on your right, you will see here. Let me change to green. If you look here, you'll see here, these are actually the quotes. These are actually the prices. So this is a price and this is a price. Now, take for example, somebody buys a currency. Somebody buys a currency and the currency moves maybe from this level up to this level. The first thing for you to do before you even buy that currency is calculate the number of pips. This pair is actually Euro JPY. So it is Euro / JPY. Now you buy a currency and maybe buy at this point, or let's take for example, you say at this point and it moves down to this point. Now to calculate the pip is the difference. The pip is simply the difference between this value and this value. So you take the value up minus the value down. Now I'll always tell people you take the magnitude of the value, mathematicians. Take the magnitude of the value, which means if you take the value up minus value down or the value down minus the value up, if it ends with negative, you change it to positive. So that is it. Now the pip appears in, if you look here, you have 2 decimal points, you have 3 decimal points here, and you have the next one, you have a 5 decimal point chart. So any pair that has JPY in it, it goes up to 2 decimal points, and the second decimal point is what we call the pip, and the third decimal point is what we call the pipette. A pipette is a subset of a pip. Now the normal pairs, the other pairs, it goes up to 4 decimal point, and the 5th decimal point is actually the pipette too. So how do you actually calculate the pip? Now, if you want to calculate pip, take for example, you stay at this point, and this is the target. So this is actually where you want to leave the market. And we say from this point to this point, you will make some profit. To calculate the pip, you read this value here, subtract by this value here, and you multiply either by 100. Take note, please. Multiply either by 100 or you multiply by 10,000. Now, if this thing goes to the 4th decimal point, you multiply by 10,000. If it goes to the 2nd decimal point, you multiply by 100. When I do that, you get the number of pips. I will get the number of pips. Remember, I said in forex, pip is actually money. So we get the number of pips. Now you know how to get in and how to trade. So that is how you calculate pip. If it goes to the 2nd decimal point, I repeat, if you check this decimal points here and it goes to the 2nd decimal point, forget about the whole numbers. It goes to the 2nd decimal point, where the decimal point ends in 3. That's you have 1, 2, 3, then you multiply by 100. If it goes to the 4th decimal point, you multiply by 10,000. That is how you calculate the pip. So we calculate the pip, that is the money you are supposed to make. Or go to the lot size, you will actually know how to convert the pip maybe to money, and you make your profit. So this is actually how you calculate the pip. Now, let me do something. This is the first method. Then the next method to calculate the pip is you can do your calculation without, this is MetaTrader 4. We do analysis on what we call trading view, not MetaTrader 4. I am using MetaTrader 4 for simplicity purpose. But we get into technical analysis, we'll use trading view, not MetaTrader 4. So there's a way you calculate the number of pips. Now take for example, you say, okay, I'm selling at this point. And if you are selling at this point, if you are selling at this point and your target is far down here, the first thing is you click on this cross share. I install something on this computer that is causing this thing. So you click on this cross share, there's cross share here. This is a cross share, so you click on it. When you click on the cross share, just take it to that point, then you draw it down. It's really difficult to actually do it. This install an alert here, and it's really causing us problem. But you click on the cross share, okay, it's okay now. So you click on the cross share, you say, okay, this is the point I'm getting in, and I want it to end at this point. You just take it to that point. When you take it to that point, the first one, 46, actually 46, then you have 84, 847, and the next one is 320. Now let me explain. The 46 is the number of candles from that initial point down to this point. 846 is the number of pips, but take note, we divide by 10, so it is 84.7 pips. You don't need any calculation to do this. So this is actually how you get the number of pips. And please also take note, know how to do the calculation manually. This is a normal pair. If you check a pair, maybe USD MXN, the number of pips is completely different. So you actually need to do calculation, because if you use this cross share, it will give you wrong value. If you have gold, XAU, USD, you need to do calculation. If you don't do it, 1 point in gold is equal to 10 pips. So you need to do all those calculations. It's important. But if you are trading currency, you don't need to do the calculation. You just need to drop and then drop. I mean, those major currencies. But if you are trading maybe USD ZAR and the other ones, USD MXN, all those things, you may need to actually do the calculation manually. So that is actually how you calculate the pip. It is very, very important. You must know how to calculate the pips, please. If you don't know how to calculate your pips, then it's just like you buy a car and you don't have money to put fuel. You don't put fuel in the car, then the car will never run, because everything in forex is centered around pip. So you must be able to do that. Now, we move to the next, a broker. A broker is simply a platform that offers trading opportunity. So the platform can be owned by an individual, it can be owned by a government, it can be owned by an organization. But take note, a broker is highly regulated. Now, a broker contributes to 60% of their success in forex. Take note, all of us, we are retail traders. So we use, when the presence of a broker has made things easy. That is why you can trade. That is why me, I can trade. Because trading started, forex started since, but very few people were trading, because you need very huge capital to actually trade. So with the presence of a broker, actually they link you to the bank and they offer those trading opportunities. So you can actually trade because of the presence of a broker. But I said a broker contributes to 60% of their success in forex. Now, for the broker, there are what we call onshore brokers and there are what we call offshore brokers. Take note, onshore brokers and offshore brokers. There's what we call regulated broker and non-regulated broker. There are brokers that are not known and there are brokers that they are regulated. All these things, forex has a regulatory board in every country. Maybe you have a SIC regulatory board and so many other regulatory boards. Now, brokers that are registered under that regulatory board, they follow the conditions given by those regulatory boards. So if you use that kind of broker, the probability of making good profit is high. But if you use any kind of broker, there are scam brokers. If you use any kind of broker, or if you use a scam broker, they will manipulate the trades and you may lose money. So that is a difference. It is very, very important to know the kind of broker that you use. Very, very important. Now, if you are already a trader, because I know there may be traders here, if you are already a trader and you need a broker, then you can contact me privately. I will propose a broker that I've used, or good brokers that I know they are actually good. But if you have a broker, no problem. Now we'll move to the next, is spread. Spread is simply the difference between the ask and the bid price. That is what Bookwork will tell you. Now, on your chart, on your forex chart, what is spread? Spread is simply a calculated amount that you pay the broker for using that platform. Simple. It is a calculated amount that every trader pays the broker for using that platform, which therefore means if there are 10 traders trading at a particular time, then the spread will be an amount, and that amount will be distributed to those 10 traders equally. Now, in forex, you must combine so many things. If you say that amount will be distributed to traders equally, then go back to trading time and trading session, which means if you have maybe 1 million traders trading and they are, they say the spread is maybe $1,000 that those 1 million traders are supposed to pay. The $1 million, 1 million people, they pay the $1,000, so they distribute the money. Now, if they are just 10 traders, the spread will be the same. That is what we call volume. The spread will be the same, which means they distribute that $1,000 to 10 people. And in essence, I said, do not trade out of session. And if you must trade within that session, then don't place a trade between 10 and midnight. That is what I said. And it's because of this spread. When you trade out of session, so many traders are out of the market. They have closed for the day, and there are very few traders. So the few traders will pay high spread. And the spread, whether I make profit or don't make profit, you pay for the spread. So immediately you place a trade, it starts with negative because of the spread. There are times that at 10, maybe tomorrow we'll complete the class with how to buy and how to sell and when to buy and when to sell to. So when you place a trade, at times I place a trade at 10, and the trade starts with negative $2. If it goes positive, it's not a day job. It's because you place a trade when almost everybody, all the traders, they were not trading. But if you place a trade between 8 and 5, maybe during the London session, it is okay. The spread will be very, very low. At times that the spread goes down to 15, 10, 9, and the rest. So you not pay even up to $0.04. The spread will really be low. So please take note. These are the things that contribute to your failure in forex. Take note of these things. Now, the next one is actually the lot size, and lot size is the amount that you want to risk on a single trade. Remember, some people, they think if you are trading with a forex trader, you say, okay, I have a $10 account, I want to risk maybe $2. So you put that $2 and it goes. That is not how it works. You use what we call a lot size. So the lot size starts from 0.01 up to even 1,000. And this is the logic. If you have a pen, please jot if you cannot remember. A lot size of 0.01, what does it mean? It means if you place a trade and it goes 10 pips towards a direction. I said if you have a pen, you jot if you cannot remember. If it goes 10 pips towards a direction, you make $1. A lot size of 0.02, if it goes 10 pips towards a direction, you make $2. 0.03, 10 pips, $3. It continues like that until it goes to 0.1. Remember, 0.1 is higher than 0.01. So if it goes 0.1, it means 10 pips will make $10. So 1 pip will give you $1. It moves like that. It goes like that to 1 too. 1 means 10 pips will give you $100. So 1 pip will give you $10. That is the risk you want to take on a single trade. These lot sizes depends on the account sizes you have. If you have a $10 account, don't expect to use a lot size of 1, because if it goes 10 pips, the account is gone, and it cannot even open a trade with that kind of amount. So that is it, and that is why I said good traders, they look at the number of pips somebody has made and not the number of dollars that person has made. This is what scammers do, and they do people. So many people, they just go, they send screenshot, and you see maybe $10,000, $100,000, and actually some of them, they are using demo accounts, demonstration account, because actually you need to trade, you need to learn how to trade on a demonstration account. It's a free account that they give you. And somebody will go use that kind of lot size, and the person makes $100,000, and you see yourself, you see it and start shivering. That is not how it works. Now, let me explain this thing. If somebody makes 100 pips using a lot size of 0.01, that person will have $10. Now, somebody use a lot size of 10, it means $100 per pip. If the person makes 100 pips, that is how much? 100 times 100, that is $10,000. But you discover that the person that used a lot size of 0.01 and the person that used a lot size of 1, of 10, all of them made the same number of pips, but the other one is higher than the other. So another thing for us is getting the capital. If you have a good capital, you can use a higher lot size and make the number of good pips. But take note, these things will always be like this. Do not concentrate on the number of dollars somebody is making. It is very, very important. Concentrate on the number of pips that that person is making. That is it for lot size. Please use your lot size and the number of pips to calculate the number of dollars you are supposed to make on a single trade. This is the introduction. We'll get to the technical analysis. We'll actually do it and we'll use the lot size and all those things, and you understand how it works. But now this is just introduction. You cannot really get deep into it. Then the next thing is stop loss and take profit. Now, this is what some people think, and so many people have contacted me concerning this too. Some people think if you have an account, maybe you have you deposit $100 in your account, if you place a trade, there are just two options, all or nothing law. If you place a trade, you make good profit or a loss of $100. That is not how forex works. And that is the mistake so many people make. So many people don't get into it. They look at forex to be so risky because of that. Now, stop loss is a value that you put, and when that trade reaches that point, it stops with the loss. So it's a calculated risk that you decide to put. Take profit is a value that you put when the trade reaches that point, it stops with your profit. So you must not be on your computer the whole day. That's why you had the different kinds of traders. If you are a day trader, place a trade, put a stop loss, put a take profit, and forget about it. When you come back, there are two things. Either it hits a stop loss or it hits a take profit. So if you do an analysis, you say, okay, this thing, I want this thing to end at this point. You don't just want it, but you do analysis and actually get the points on the analysis. Now, if you say, okay, this thing has to end at maybe 2 pips or maybe 20 pips, and you use a loss size of 0.01, which means if that trade reaches that point, it stops. So you are ready to lose $2. And if it goes towards that direction, you are ready to make $4. That is actually how it works. So that is how you put a stop loss, take profit. We'll get to tomorrow. We'll actually do it practically, how to put a stop loss. You do it when you want to place a trade. So we have not known how to place trade now. So tomorrow we'll do all these things. We'll enter the value, stop loss, take profit, and the rest. Now, volatility. Volatility simply is the how fast or how slow the market is moving. There are days that the market is really, really slow, and there are days that the market is really, really fast. So volatility is simply how fast or how slow the market is. It's very important. Now we move to the next candlestick. I'll go to the chart and try to explain all these things. Candlestick. A candlestick is a statistical representation of data in the financial market. So is the representation of past event. It means when the price or when the exchange rate of a currency goes to a certain level, then they record it. It goes to another level, they record it. So it's just like a line graph. You have 3 representations. You have a candlestick chart, you have a line graph, and you have what we call a bar chart. Now, a support is simply a line, is a point at which price reverses from below, and a resistance is a point at which it reverses from above. So these are the different terminologies we use in forex. Now let's get to the chart and we'll try to get these things. Now, I said you have on your chart, you have what we call candlestick. Now, a candlestick is actually a statistical representation of what is happening in the market. There are 2 kinds of traders, please. 2 kinds of traders. There's what we call fundamental traders, and there's what we call technical traders. Some people do the trade forex based on what they see on their chart. So they do what we call analysis. They analyze this chart and they get their prediction, whether this thing has to drop or it has to rise. Then there's what we call, that is technical trading. Then fundamental trading is actually those that go and they check news. So they trade based on news event. News events actually affects this thing. And it doesn't mean you should sit on your computer set for the whole day, or you should sit on your TV set the whole day watching news. It doesn't mean that way. There is a site, forexfactory.com or investing.com. Just go there, you check every day, and you get a news event. On Sunday, the news event for the whole week is published there. The event, the time, and the kind of event, whether it's a high impact, moderate impact, or low impact news. You just check and you see it there. But you should be updated. You should know so many things too, because we have things like this US-China war, it affected this thing. We have natural disaster that affects the forex market, because I said this thing actually depends on the economic activity of that country. COVID-19 is actually affecting the forex market because so many people, there's lockdown. So many people are indoors. They're indoors, so they cannot actually move from place to place. They cannot do transactions, and the economic activity of most countries is actually down. So you need to understand all those things. Now, if you look at this chart, this is a candlestick chart. If you look at this chart, you have 2 different colors. You have a green color and you have a red color. Now, the green color is actually what we call a buy candlestick, and the red color is what we call a sell candlestick. And what does this candlestick actually mean? This candlestick means, if it is a green candle, it means people that actually bought this currency at this point, they were higher. They were very high. That is why this candle ended as a buy candle. If a candle has a red color, it means the sellers were dominant. So the sellers, actually, people sold the currencies they bought, and the candle will end as a sell candle. This candlestick actually is the gold standard when it comes to forex. Now, some people will trade using what we call indicators. Indicators are simple tools, very simple. Let me show you guys one. And this is the indicator that is causing this problem. This is actually an indicator which tells you to buy or tells you to sell. It's clear. It just gives an arrow. But if you use this indicator, trust me, in isolation, you will get why you ever join for learn forex. So me, I am a naked chart trader. I look at this chart and I trade based on this chart. So this candlestick, they have names. There are over 50 names, which will tell you this thing has to reverse. It has to start going at it down. So you need to sell. We need to buy. This one, it tells you this thing has to go up. Like these two forms what we call a bullish engulfing pattern. This one, this is a bearish engulfing pattern, and this is a doji. This one, this is a bearish engulfing pattern. Then, so this thing actually, they have names. This candle, they have names. So we have neutral candles and we have what we call reversal candles. So you do an analysis based on this. Now, that is it. And I also said volatility is how fast or how slow the market is. Now, this candle, each candle here takes 4 hours, a 1 hour. This is a 1 hour chart. This is a 4 hour chart. So this candle, you can switch to any chart, whether it's a 1 hour, and this is what we call time frame analysis, multiple time frame. So you can switch to the 30-minute, you can switch to the 1 hour, you can switch to the 4 hours. Now, if you are on the 1 hour chart, what does this thing mean? It means each candle here takes 1 hour to be formed. Which means if you have a very small candle like this one, if you look at this candle, it's really small. This candle takes 1 hour. If you look at this very long candle, it takes 1 hour. So volatility can be determined by the size of the candle. When this candle is too small, then there's volatility is really high. It's really, really low. When the candle is really high, then volatility is really, really high too. Now, if you look at this move, imagine somebody will place a trade here or buy here, and this thing takes maybe 1, 2, 3, 4, 5, 6 hours dancing within 1 point, and somebody buys here and it takes 1 hour, move from this point up to this point. Now, I've taught you what pip is. If you calculate this thing from this point to this point, this is more than 30 pips. So somebody will make more than 30 pips within 1 hour, and you are there, you place a trade and it does not go even up to 10 pips, and you take 6 hours. That is the logic. Time is smart. So know how to spot out these things. Now the market has a way it moves. You have an uptrend, you have a move up, you have down. Let me just try to illustrate. You have a move up, you have down, it goes down. We'll go to get into technical analysis, we'll do that. So you have a move, this is how the market moves. So as a good trader, you get in at this point and it goes up. You get in at this point, it goes up. You get in at this point, it goes up. So in essence, what am I saying? Where do you buy or where do you sell? You buy at the beginning, and when it goes up, you make profit. It comes down again. This is actually what we call pullback. You buy at this point. When it goes up again, you make profit. This is introduction. We'll go get into technical analysis. We'll go detailedly. I'll move stepwise so you understand it clearly. So when you buy at this point, it goes up. You wait. This is actually pullback. You buy at this point, it goes up. So this is the point that you buy. You buy at this point, you buy at this point, and you buy at this point. If this move is down, where do you sell? So it goes down, it goes up, down, goes up, goes down. So you sell high, and when it goes down, you make profit. You buy low, when it goes up, you make profit. That is how it goes. So you buy or you sell when it is going up. Please take note. It doesn't mean when it goes up. When it is going up, that is how your profit is increasing. So you don't need to buy. Maybe you buy at this point and you sit and wait for it to go up to this point before you see profit comes like maybe a bunch. It doesn't work that way. But when you buy, as it is going up, that is how the profit is increasing. You see the profit actually increasing. So that is how you buy and that is how you sell. Now, if you get to the chart, this is the chart. If you get to the chart, based on this, where do you buy and where do you sell? It's really, really important. Where do you buy and where do you sell? You discover you buy, let me see. You buy at this point. If you look at this thing, this is actually a point. So you buy low, which means this is a low point. This is a low point. So buy at this point. When it goes up, move from this point, you make profit. Then it comes down, you buy at this point. This is a low point. When it goes up, you make profit. You buy, it comes down again, buy at this point. When it goes up, you make profit. That is how we trade. Now, if you can decide to sell at this point, but it is risky, technical analysis will get detailed into it. So this is where you buy, and this is where you buy. If it is selling and going down, That is actually how it goes to. So it goes up, it goes down, it goes up, it goes down. So this is where you say at this point, you say at this point, you say at this point. So that is it, and that is actually how you trade. It is very, very important. For us, it's very simple. The first thing is it depends on how you get the knowledge, and secondly, it depends on what we call trading emotion. Do not be hasty. Forex is not a get rich quick scheme. I always tell people, even if before you want to enroll, I tell you, forex is not a get rich scheme. Some people actually get in and they get rich very, very fast. Some people get in and they take time. So there are two things. Some people get rich because of hard work, and some people get rich because of luck. There are times I just see a clear move here, you just use a very high risk, maybe use a lot size of maybe 1, and you move from this point up to this point. You have maybe 100 pips, that's $1,000. Maybe on a $50 or on a $100 or on a $500 account, then maybe $1,000 within a very, very short period. That is what we call luck. But some people actually make profit, and most people, they make profit in forex based on hard work. So they sit and actually work. So forex is very easy if you know what to do. But if you don't know what to do, trust me, you regret ever doing this. So the first thing is, I always tell people, and you need to know this, invest in knowledge. That is the first thing. We invest in knowledge, money will come. But if you decide to invest in money, then knowledge will not be there and you will lose that money. Penny wise, pound foolish. There are times that people sacrifice, they decide to lose maybe 100,000 because they are too greedy not to spend 50,000 and learn. I've had this kind of cases several times, and this is an advice I'm giving you guys. Invest in knowledge and the money will come. If you struggle to learn maybe on your own, forex, you can never learn forex on your own. That is the bitter truth. Even if you learn, you need a mentor. Me, I have mentor, not one, not two. With the little I know, I have mentors that always guide me. But if you decide to learn on your own, trust me, you will blow so many accounts and you may come back and get a mentor because there are some technical things that you will never understand. Take, for example, that spread I explained to you. So many people place it in the evening or in the night and they make the loss huge amount. They don't even understand why. Some people, they place it at odd moments. They don't understand why. Some people use very high loss sizes. They don't understand why. And the funniest thing is, if you read what books will tell you, you'll be shocked there. We'll get into technical analysis. I will point out those things clearly. We'll go to book what books will tell you, and we come to the rate chart and you see the reason. Just 5% of traders actually make money in forex. Just 5%. It doesn't mean people cannot make money, but most people, they want to use the short method to make money, and some people, they don't want to learn, but they want to make money. So it is very, very important. So that is it, and I think that is what we have today. Let me get back to the chat and see, because tomorrow we really have work here to work on that MetaTrader 4 interface. Part 1 is not easy, so we need enough time to work on that. So tomorrow we'll do MetaTrader 4 interface part 1. So you learn how to place trade, how to buy, how to sell, how to close a trade, and the rest. So that is it for the class of today. Is there any question? If there's any question, please just indicate by show of a hand, then I'll unmute you and ask a question. Any question? Okay. Everybody is quiet. It means there's no question. So if there's no question, then I think we can end the class of today and get ready for tomorrow. Tomorrow will be the last day. Get ready for tomorrow. Okay, there's a hand up. Mr. Alfred, his hand is up. So I've given you permission. Please unmute yourself and ask a question.
Okay. I didn't get a data. I just wanted a little more clarification on the aspects of leverage. Once again, please.
Okay. Let me please, Mr. Paul, just a minute, please. Mr. Paul, let me sort out this before actually I get to you. Now, a leverage is, as I explained, is actually borrowed money. That is a layman's language, and is in layman's language. And I explained that that is the most important thing you need to know. So it is borrowed money. So I explained that when you get, maybe you start trading and you get maybe $10 in your account. When you are creating the account, you choose the leverage you want to use. They have a series of leverages, and it depends. Some brokers, they have maybe 10, 100, 200, 500, and the rest. So that is actually the borrowed money I'm talking about, which means if you fund your account with maybe $10 and you use a leverage of 1:200, what it actually means is the amount we have used is multiplied by 200. So if you place a trade, you are ready to actually make good profit. That is why you can double your account. You can have a $10 account and you take maybe 2 hours, you see yourself making $20 profit. It's because of that, the leverage system. Now, but you should understand leverage systems are very, very dangerous too. So you should understand those things. Now, if use a leverage of maybe 1:200, it is ideal. That's the ideal leverage. 1:200, 1:400, 1:500. But if you use a higher leverage, it is very risky because you can take one day and you blow your account. And I said the second function of a leverage is actually protects your capital. So if you place a trade, if you use a leverage of, take for example, 1:200, it means you cannot, the trade, if you are losing a trade, it cannot go maybe negative, you cannot go 50% or 60% against you. So if you lost maybe 60% of your capital, that trade will close. When you open so many positions, they'll tell you don't have enough money, but you see good money in your account. That is actually protecting your capital. But if you use a leverage of maybe 1:4 or 3,000, it will get, if you use a leverage of 1:3,000, that trade will only close when it reaches, you lost everything in your account. I mean, everything. So your account will go down to 0.00 before that trade will close. So our advice, you use a leverage of 1:400 doing account creation. After this, we'll do stepwise. So after this normal training, we'll move to the technical part. Those that actually want to get into it will get on board. Then we'll do all those things. We'll reach a certain level that I'll actually create an account. We'll do a live class on how to create an account, and you'll be following me step after another. Because if you don't do it, you may use you may use something that you don't understand. At the end of the day, you start losing money every day because of what you used. So it is very, very important. And please take note of this. 1:400, 1:500. That is what I recommend you to use. Anything above that, do not dare. If you use maybe below 1:400, there's no problem. But 1:800, 1,000, do not try it. It is too risky. So that is it. Remember, forex itself, leverage systems are very risky. But in forex, you take calculated risks. Don't take uncalculated risks. Some people, they say forex is risky, so they just close their eyes and they start buying a currency or they start selling currency. There's a difference between trading and gambling. Most people, 90% of traders are gamblers. They are not traders. Because forex has a lot to do. It has a lot to do. But most people, they just go, and that is why you see somebody telling you, I read books and I can actually trade. It doesn't work that way. Most of them, they are actually gamblers. So you need to understand all these things, especially that leverage. Tomorrow we'll do the next one, margin level percentage. Combine it with leverage and you understand it better. I know why, or you understand why when it goes to 70%, that trade will close automatically. You don't even need to close it. If your stop loss is not there, even it closes automatically when it goes to maybe 60 or 70% negative. If it is understood, then I think we can move to the next. Now, Steven Modest, please, Mr. Paul, just be patient. Let me read this one. Where should we install MetaTrader 4 software? phone or PC, which version of MetaTrader 4 should we install? MetaTrader 4 or MetaTrader 5? Okay. Now, this is how I do it. You should install on both. MetaTrader 4 on your phone, you just go to Play Store and download it. MetaTrader 4 on your computer, that was a little bit complicated because you download this, the brokerage MetaTrader 4. So you need to download it. I'll show you guys all those things. So you download on MetaTrader 4 on your phone or your computer. Now I explain the difference between MetaTrader 4 or MetaTrader 5. It depends on you. You can decide, I'm very comfortable using MetaTrader 4, but you can decide and use MetaTrader 5. MetaTrader 5 is an advanced form of MetaTrader 4. So this internet connection is a little bit stable with MetaTrader 5. But the problem is MetaTrader 5, most of these trading tools, it rejects. Some of these brokers, they are not registered on that MetaTrader 5 platform. That is the difference. So that is why I prefer using my MetaTrader 4. I don't want things to complicate. I don't want to complicate myself. I just use my MetaTrader 4. You install on your computer or on your phone. And I have it both on my computer or on my phone. This is the reason. Your phone, you may place a trade and your phone starts misbehaving. Especially, I said there are two kinds of traders, fundamental traders and technical traders. When there is news, the market moves abruptly. So within 5 minutes, your account may disappear. And imagine you place a trade and you did not put their stop loss, which is the worst mistake you can ever make. You did not put their stop loss, and that news, there's that news event, and maybe your phone goes off or your phone starts misbehaving. Most often, maybe the phone may freeze. You are not connected to your computer. You will lose that trade because of that. So what I do is I connect the same account to my phone and my computer, so that when anything happens to my phone, I just switch to the computer and do what I want to do. If anything happens on my computer, I can go to my phone and do it too. But the best way is you should have it on your phone. On your computer, it is optional, but on your phone, it is compulsory, because you move from place to place, you can easily carry your phone. So anything happens, and connection on your phone is faster as compared to your computer. So you can actually do all those things without any problem. So that is it. Then Mr. Paul, Chinda Paul, I'm listening now. You can just ask the question.
Right. Good morning.
Good morning, sir.
Sorry, I would like to know concerning the class. For the introduction, I think everything is clear. I would like to know concerning the class, is it possible not to have a Zoom, like to meet you one-on-one, like have a class with you on specific days, if that's possible?
Okay. This is a system. That's something good. I thought I would do that. I'll explain that during maybe tomorrow, but it's good we have asked now. It's good people prepare themselves too. Now, we have two set of classes we have. As we hold two different set. You can have a one-on-one class, or you can have a general class. The general class is actually 4 sessions per year. So this is a second session. They'll have the third session around maybe September, then the last session in December. So you can join the general session, or you can join the private class. So most people, even, they actually prefer the private class. Some people, it's just that the fee for the private class is high. That is the truth. The fee is high because it is more expensive. To me, to activate connection and the rest, it is more expensive. So the fee for the private class is a little bit expensive. But I have private class, one-on-one physical class if you're in Bamenda, one-on-one Zoom class if you're out of Bamenda. If you want me to work, like one lady, she attended those free classes last week, and she told me she preferred the private class. So she's preparing for the private class. So we can have the private class or this general class. But for the fee for the general class, I hope everybody knows is even on this flyer. Then the fee for the private is always 100. That is the fee for the private class. I work with you one-on-one, and most often I work at your own pace. So we sit and we agree the time. Now we sit and we agree on the time. We agree on the time that we are supposed to work, and I work at your own pace. So if you don't understand anything, you can easily stop me. And it's actually like a discussion. It's not this kind of class that I just come and meet everybody and I explain before you ask a question. So the one-on-one class is actually like discussion class. So when I'm teaching, anywhere you have a problem, you just tell me and you ask, and we continue. So that is actually how it works. those two classes. You can decide you join the general class, which is cheaper, or you join the you decide to go for the private class, which is just one-on-one. So that is it. I hope it's okay.
Yes, I think.
Okay. So I think that's it for today. So to have the next class tomorrow, and please, we have done almost everything, but the class tomorrow, do not miss. You know how to place a trade. That one is really exciting because it's more of practical. So you know how to place a trade, you know how to buy, you know how to sell. Where you buy is actually see the profit going or see the loss. You see yourself making some good profit or it goes negative. So the class tomorrow will really be interesting. Don't miss that class. So that is it for today. And if there's no other thing, then I think we can end the class of today. So I wish you a happy and fruitful day and see you tomorrow.